Three stocks that I think have tons of upside potential over the next year to 2 years, 3 years. Stocks that I own and that I'm buying. If you like this kind of content, like, subscribe, comment below. I respond to every comment. Let's get into the three stocks. The first stock we have up here is Okta. Okta is a cybersecurity company that's been around for a few years, and they have had tons of growth, and they have contracts with FedEx, Wyndham Resorts, so they've definitely got some high profile clients underneath them. Now, they have hit a pretty big decline in stock price, which a lot of times is what we want to see, especially if the PE ratio lines up for a good price. So this thing's been pretty beaten down. We had a high here of 290 right over, and now we're sitting around in the $80 to $90 a share range. I just started picking this stock up last week. So let's check out and see what our numbers are looking like, our fundamentals here on Okta. I did have a video, the last video I posted, I went into Okta in a little more detail. I'll post the link to that video at the end of this video. So Okta, revenue's looking good. They've had steady revenue growth. Almost every quarter has been positive over the last few years. So the big thing in here is net income. We just hit profitability in the last 2 quarters. So right here you can see the quarterly. We've had 2 profitable quarters. Of course, we had a decline in net income, and we've been working our way back up to the last 2 quarters being positive. However, we have not had a trailing 12-month positive year. So we're getting close, though. You can see the steadily inclining trailing 12-month chart on revenue. So that is, if I'm investing in a stock that's not profitable, this is what I want to see. I want to see a stock that their numbers look good, they've got steady revenue growth, and their net income is on a clear path to profitability, especially here with these last 2 quarters. So with that, I'm excited about Okta. I don't invest in companies very often that haven't had trailing 12 months of pure profitability, but I like what I'm seeing with Okta. So since Okta has not had profitability for trailing 12 months, they aren't going to have a PE ratio. It's going to be 0. So this is why I like to, if you're a beginner investor in stocks, if companies don't have decent history of profitability, then it gets a little harder to make good decisions on what kind of what these stocks you want to buy. If you have a little more experience, you can look at other metrics. So with a situation like this, which they're just coming into profitability, I will use the forward PE. I don't like to use the forward PE regularly because I'm more of a backwards looking type of investor. Warren Buffett has a similar viewpoint on that. Future growth and predictions are fantastic, and I want to see those looking good. However, I put more weight into what the company's done in the past. I feel like the best indicator of future behavior is past behavior. And so if I see a company that's got a great balance sheet, that's had good growth, if they have a team that continually raises the bar, that's what I want to be investing in. I want to have that at a good price. So if we look at forward PE on Okta, you can see back here in 2023, we were in the 40s, and now it's kind of come down into the 20s, which is, if the next year, if we're going to have PEs in the 20s or 30s for the amount of growth and revenue and net income that Okta has had, if we keep that up, these will be great prices, what we're buying now for this company. And another great, awesome thing about Okta is we had a bad situation happen in 2023. Okta had a data breach in November of 2023, and being a cybersecurity company, that's bad, of course. So the cool thing was, though, this stock had already been beaten down, and let's see, September, the data breach happened right here in this area. And we did not see a mass sell-off here. So the great thing is also revenues and numbers haven't been affected by that data breach. So what I really like about that is it shows that not only do the companies that are with Okta trust Okta and they weren't leaving, is that also we're seeing a share price that can't be affected by awful news because it is in a good value range. A lot of the times, if this thing, we would have thought looking at this chart that the data breach happened back here, but it didn't. It actually happened around here, and we are up from those levels in the year plus since it's happened. Okay, so let's come back over and look at a few more metrics on Okta. Obviously, we saw the revenue growth, and we saw the net income. We'll check out their balance sheet. I always like to come over here and look at the cash on hand, and we see a good cash on hand. We've kind of plateaued here for a while, which we still got long-term growth with cash, and it seems like they're maintaining this well. I'm sure after we come into profitability, this thing will take off again. But with a company that has been in the red and hasn't been profitable, a cash on hand that's been running sideways, I'm okay with that. And it's got long-term growth for the cash on hand. So let's look at the balance sheet. All right, total assets are just under 9 billion and total liabilities are just over 3. So that's awesome. That's almost a 3-to-1 ratio for assets to liabilities. And also you can see up here, we've got 2.2 billion of cash on hand, which covers, more than half of their total liabilities. So that's a good number to see as well. And just looking at the income statement, we can kind of see a numbers level of the revenue growth they've had. So we can see here, 2019, we were at 399 million. Jumped into 2020, we had a big jump up to 586 million. Big, almost 50% move to 835. You can see 1.3 billion, 1.8 billion. And now we're at 2.2 billion. So we've seen some great growth here. Of course, as the company grows, it will start to slow eventually. That's what we usually tend to see. But if outlooks for Okta, especially from their team, are really conservative. So if this thing continues to grow at the rate it's been growing, we should see some awesome growth with the share price as well. The next stock we are looking at is Celsius. Celsius is an energy drink company that focuses a little more on the health side. Back in 2022, around the August time of 2022, Celsius and Pepsi got together. Pepsi is the distributor of Celsius, and we saw their stock almost do a 3x up, and we kind of hit this double top up here. And since it has just fallen and fallen and fallen, partly due because it did get really overvalued up here, but also secondly, we saw a tremendous slowdown in revenue growth, but this was due to Pepsi kind of overstocking them, and they're since have been moving through their inventory. So that really affected Celsius's numbers because we were kind of going through that supply chain issue with Pepsi. So we should start seeing things pick up again in revenue. We'll kind of come over here and we can look at their revenue growth. So let's go to the income statement here with Celsius. All right. So 2018, we had revenue of 52 million. We had about a 50% increase up to 75 in 2019, a big jump to 130 in 2020, almost a three up, 2.5 times into 2021. We had over a double up into 2022. We had over another double up into 2023, but in the trailing 12 months, we have seen very slow growth. The trailing 12 months is about a 5% growth, so almost a break even. We can see here from December to the last quarter, we've got one more quarter to see a full year, but for the last 3 quarters, we were just barely up. A good maybe 4% increase in since December of 2023. But like I said, that's got a lot to do with the supply chain issue with Pepsi. So even if we start picking back up and we're hitting just a fraction of the growth we were seeing, I think we'll be in really good shape. Not to mention the PE ratio on Celsius is in a really good spot. Right down here, we saw even back here, we were having P ratios of up to 75. And of course, we hit this huge one back here in 2021. A lot of times, this is when they're going through some earnings per share swings. So we can see this big, 0 up to 1200. So a lot of times, when we're kind of going through unprofitable and profitable quarters, this really affects our P ratio. So a lot of times with this type of situation, you kind of just want to let it level out a little bit. But in the more recent history, we saw it get all the way up to 121 PE, 90s. So right now we are below 40. It's saying right now 37. Sometimes that number is not always accurate. The Robinhood one usually is pretty spot on. But yeah, 37, a little over. And that's a great PE for a company that's had so many double ups in the past few years and has the potential to grow into other markets. They're not that expanded internationally, so they've got a lot of upside for the international market. And even if they going back up to 30 to 40% year-over-year growth, that's a huge number. And being in the 30s in the P ratio, that's a really good area to be buying a growth stock like Celsius. So let's check out Celsius's balance sheet real quick. All right, we've got $755 million in cash on hand, and what a great chart we see here. We've seen an influx of cash on hand, and so they've been growing that at a tremendous rate. On their balance sheet, we've got $1.5 billion of total assets, and we have just under $1.3 billion of total liabilities. This number's okay. I like the total assets are more than total liabilities. I would like this to see 50% higher, so I'd like to see this more like around $1.8 billion. I'd feel a little better about that. But with all the other numbers being so good with Celsius, I can overlook that a little bit. And they're in a period of lots of growth. So, sometimes the balance sheet is going to take a little bit of a hit. We do have $755 million of cash on hand. And so that's well over half of their total liabilities. So I do like that. That's a good ratio there. Just looking at the revenue on Celsius, we had a huge run here. We've seen a little bit of the dip from the supply chain issue. But I think this will be just a correctional period, and we'll see this thing take off over the next year or so. And I think there's a lot of upside to be made with Celsius. The next stock we're looking at is Nike. Now, this one's got a lot of debate on the internet. A lot of people are saying it's done for, it's over with. But guys, Nike has such a moat. They're a lifestyle company. And this stock has been going since the 80s, and every huge dip this company has had, it has been bought up. Going back to, highs around $15 in 2008, we went down to $11 a share, almost right around $10 a share. And within just a couple years, we doubled up. Every time this thing drops, it's a buying opportunity historically. And recently, over the past couple years, Nike has had some CEO changes. They had a CEO that was really trying to change their model and make them go to a direct-to-consumer sales model, and it just failed. It didn't work out. It was the wrong decision, but now Nike has the people behind it that are ready to get it back to its glory days, obviously. And a company like this, they make mistakes, all right? This stuff happens. The mistakes is usually where we get these huge buying opportunities, because when you have a team like Nike that has such a moat, and when they get the right people, okay, we've done something wrong, let's change the way we're doing things. Man, these companies will start to take off again in no time. And so they've just got to get back to what's made them this profitable, what's made them have this long-term success. And once they get the wheels rolling on this thing again, we're going to hit all-time highs. And so right now, we're seeing where we had a high back in November of 2021 of around $170 a share, and now we're at $71 a share. Our PE ratio is under 20 right now, almost. We're right around 20. And anything under 25 for Nike is a tremendous buying opportunity. Obviously, way back here around 2010, it did get under 15. but that's about as low as we've seen it in recent history. So anytime this thing is under a 25, it's just a tremendous buying opportunity. A company like Nike that's got such long-term success, when they have this big of a dip, guys, it's hard not to buy these companies. Because even like we'll check out their revenue growth over time. And I mean, just look at this thing. I mean, this is going back to 2010, and it's just been up and up and up. And when they have dips in revenue, it just they make all-time highs, and we're seeing another dip in revenue. And it's just, they're a monster. They're a titan. Trailing 12 months net income is still, I mean, even the last 10, 15 years is going up and to the right. And that's awesome for a company that's been around as long as Nike has. A lot of times companies like this that have been around for decades upon decades, their net income really starts to balance out and kind of run sideways. And then you're waiting for that revenue growth is where you're getting your growth. But Nike has still been growing their net income levels, over the last 15 years. And we're not even at the top of where they could be. We know that around here, they were at the top, and we still have time to get back up to those levels. Another thing I want to look at with Nike is their margins. So with Nike's a company that's been around since the 60s. Look at their gross margin. It has been steadily increasing over the last 15 years. I mean, for a company that's been around that long and to see that their gross margins are steadily just rising, that is fantastic. So a lot of times, like we've said, companies like this, they plateau at a certain point, but they're still growing their gross margins, which is fantastic. We'll come over here to net margin. This is basically, the earnings per share equation of it. This is really where the money's being made, and we see the same thing. We see growing, trailing 12-month net margins. So that means that their net margin and their gross margin are moving together, both moving forward. That's awesome for a company that's been around as long as Nike. This just shows that the team behind Nike is just constantly raising the bar, and it's hard not to buy a company like this when you see a dip like this. I mean, this is a historical buying opportunity for Nike. If this thing keeps going down, I'll feel comfortable to buy more. And if there happens to be some black swan event where Nike was to completely go out of business, I would just be completely surprised. But at the same time, my portfolio is divided up amongst other companies to where if the worst case scenario was for Nike to go out of business, I would still be all right. And that's another important thing here when buying stocks is I'm showing you 3 stocks today. So you could go in and buy all 3 of these, at the same time. And if just something crazy happened in the next few years to one of these stocks, you still have 2 other companies you're buying. That should give you consistent profits in your portfolio for the future. So if you like this video, please like, subscribe. We go over stocks. We talk about the stock market, real estate. Like and subscribe, comment below. I respond to every comment on this channel, but y'all have a great day.